It's good to see you. I meant to do this live, but unfortunately life got in the way. And I've recorded this session, and I hope you find the session useful. I know one of the problems with recorded sessions is you can't ask the questions you want to ask. So I'll give you a forum where you can ask those questions and I will try to answer them. For the moment though, here's what I'd like to talk about. I'd like to talk about the importance of connecting stories to numbers and how without telling stories you really cannot value companies. And I want to talk about how COVID has or has not changed that need. So let me go back to basics. When you think about why people have trouble valuing businesses, valuing companies, we tend to think of mechanics, that they can't get the discount rates right or estimate the cash flows. But the truth is, there are three big enemies that valuation faces, and none of them have to do with the numbers. The first is bias and preconceptions. What do I mean by that? When you sit down to value a company, whether you like it or not, you come in with priors, things you think you know about the company that you try to bring into your valuation. And the stronger your priors, the more skewed your valuation is going to be. That's why when you ask somebody else to value a company and you pay them, you're already creating the groundwork for bias. The second big enemy of valuation, and this is an increasing problem, is complexity. It's become too easy to build elaborate valuation models. I've seen investment banking valuation models that can run to 500 line items and 25 pages. And you can do that now because we have all these powerful tools at our disposal. In the process though, we're devising models that we really don't understand. Black boxes that essentially value companies for us. The third big enemy of valuation is uncertainty. As human beings, we don't like to deal with uncertainty. We'd like to wish it away. And guess what? When we face a great deal of uncertainty, we either run away or we go into denial. That's why people refuse to value young companies, technology companies, companies in the middle of a crisis. And by doing it, they're avoiding the key issues that you need to face to value companies. So one of the things I'd like to do to illustrate this process of storytelling and number crunching is I'd like to use an example. So let me pick a company where everybody has a point of view. I either love the company or you hate the company. So I'm going to throw this out to you. And even though this is a virtual session, act like I'm asking you this question. If I asked you to value Tesla, what are your priors in Tesla? Do you love the company and think it's going to be $1 trillion company? Or do you hate the company? You hate Elon Musk and you think it's going to be a scam? Let's face it. Tesla is a company which is personality driven. And you know who the personality is, right? Elon Musk and Tesla locked at the hip, and what you think about Elon Musk will drive what you think about the company. So all I need to do to figure out your bias is ask you, do you like Elon Musk? That answer is going to tell me whether you're going to bring bias into the process. You're saying, why does it matter? Make a choice, because I'm going to put you on the spot. When you sit down to value a company, there are four basic questions you need to address. The first is, what are the cash flows that this company makes from its existing investments? I mean, let's face it, company's been around, it's already made investments. You try to figure out what those cash flows are going to be. Second, you ask, what is the value that's going to be added or destroyed by future growth? You're saying, how can growth destroy value? Growth is a double-edged sword. The good side of growth is it'll make your equity earnings, your firm earnings grow faster. The bad side of growth is you have to reinvest to get that growth. And let's face it, if you reinvest too much to get a given growth rate, growth can turn on you. It can actually destroy value. Third question you have to address is, how risky are your cash flows? Let's face it, riskier cash flows are worth less than safer cash flows. And finally, to get your valuation to closure, you got to tell me when your company will be a mature company. You're saying, what does it even mean? A mature company is one that grows at a rate less than or equal to the economy. So when you sit down to value a company, those are the questions you're trying to answer. And as you do it, uncertainty is going to be knocking on your door. And while you think about uncertainty as this one big glob, a mess that you have to deal with, let's face it, uncertainty can come from lots of different places. One of the things I suggest people do when they sit down to value a company or a business is ask them to list out their uncertainty. Make a listing and then put that uncertainty into buckets. Here's the first categorization. Your uncertainty can either be estimation uncertainty or economic uncertainty. You're saying, what's the difference? Estimation uncertainty is because you haven't done your homework. If you go out and collect more information, do more homework, estimation uncertainty will decrease. Economic uncertainty is out of your control. You can do all the research in the world, talk to all the people, talk to management from now till the cows come home, but economic uncertainty is there to stay. And I have some bad news. In most companies, 90% of the uncertainty you face is economic uncertainty. In the middle of a crisis, it becomes 95, maybe 99%, which means homework is not going to make the uncertainty go away. The second categorization of uncertainty is micro versus macro uncertainty. What's macro uncertainty? It's uncertainty about interest rates, how the global economy will do. What's micro uncertainty? It's uncertainty about the company, the management, its products and services. Micro versus macro. You're saying, what do I care? Macro uncertainty goes into your discount rates. Micro uncertainty, you can diversify away in a portfolio, but you still have to bring in the expected effects into your cash flows. The third grouping of uncertainty is discrete versus continuous uncertainty. Continuous uncertainty is uncertainty you're exposed to every moment of every day. So if you're a European company with US operations, every time the euro-dollar exchange rate changes, your cash flows change. Discrete uncertainty lies dormant for extended periods, and when it does pop up, it pops up suddenly. I'll give you an example of discrete uncertainty. You're facing the possibility of distress. Distress is discrete uncertainty. It's a 0-1. It either happens or not. And I'll give you what I think about uncertainty, which is uncertainty by itself is not the issue, but the way we deal with uncertainty varies. We're much better at dealing with continuous uncertainty than discrete uncertainty. So to set this process up, I'm going to basically take what I think of when I think about uncertainty. And it comes from a perspective that I find very useful, which is to put companies into a life cycle. What do I mean by that? A startup is like a baby. A young company, a very young company is like a toddler. As companies age, they become teenagers, then you're the peak of your life, then you become middle-aged, and then you get old, and then you go into decline. Companies go through those same cycles. You're saying, why does that matter? Early in the game, you have lots of uncertainty, and the uncertainty tends to be company specific. You don't know whether the company has a business model, whether it'll make it. As companies mature, the uncertainty decreases, but it tends to shift from company specific to macro uncertainty. When you're valuing Volkswagen, your primary worries are about the economy, not about whether the company has a business model. When you value young companies, expect to see not just more uncertainty, but a different kind of uncertainty. So I'm going to set the table for one of the things that I find is useful when I deal with uncertainty. I've always believed that a good valuation is a bridge between stories and numbers. What I mean by that is I often see valuations show up as spreadsheets. A spreadsheet is not a valuation, just a collection of numbers on a spreadsheet. A good valuation connects those numbers to stories. So if you tell me your company will have revenues of $3 billion and ask you why, the answer I want to hear is, what is it about this company? What is the story you're telling about this company that will allow it to have big revenues? If you're showing me 30% margins, which are high margins, the question I would have is, what does this company do that allows it to have margins this high? A good valuation is a bridge between stories and numbers. It's something I didn't know when I first started teaching and talking about valuation. I did valuation like a numbers person did. Just put the numbers down, let the numbers speak for themselves. I've learned that without a good story, valuations lose their meaning. So a few years ago, I wrote a book on connecting stories to numbers. If you're interested, the book is called Narrative and Numbers. It's a fairly reasonably priced book. So if you get a chance, if you want to read it, I'd welcome your feedback. And in that book, I break down the process of valuation into 5 steps. I said the first step in valuing a company is you need to tell a story about the company you value. Stories start first. Second stop, you got to make sure the story you've told is possible, plausible, and probable. Sounds like I'm playing on words, right? Lots of things are possible, a subset are plausible, an even smaller subset are probable. I'm raising the ante with each word. Third, once I've checked my story, made sure it's not a fairy tale, check for plausibility and probability, I convert each piece of my story into drivers of value. You're saying, what are you talking about? When I tell a story, it has consequences for revenue growth, for margins, for reinvestment, for risk. I'm going to flesh out those connections. And once I do that in step 4, the valuation kind of does itself. While I'm doing all of this, I want to make sure that I don't fall in love with my own story, because it's possible I've missed some key pieces. So in step 5, I call this keep the feedback loop open. I listen to people tell me what I might have missed because I want to make my story better. So you ready? We're going to try this on a company. And to give you the drivers, even if you've never done valuation, let me lay out the key levers you can control. The first is revenue growth, which is a function of the size of the total market and the market share you give the company. The second is operating margin, which is determined by pricing power, brand name, cost efficiencies. The third is how efficiently you can deliver that growth. How much do you have to invest to get that growth? That gives you the expected free cash flows. In the denominator, you have a risk adjustment. Part of your money, your capital comes from equity. You have to tell me what equity investors demand for buying equity in your company. And part of it comes from debt, where lenders charge you money for lending you money. And in doing all of this, you have to recognize that there is a chance your company will not make it. Let's call that failure risk. I think of everything I do in valuation as playing out in this picture. So I'll take you back to June of 2019. I value Tesla, and it's a company I've been valuing every year since 2013. It's a company where I find myself in the middle. Why? Because it's, as I said, either loved or hated. The people who love it think it's worth tens of thousands of dollars. The people who hate it think it's worth nothing. I fall in the middle. I think the company has potential, but it has issues. And one of its issues is that the management team are actually a CEO who's not quite grown up. So when I valued Tesla in June of 2019, it was at an absolute low. It was right after Elon Musk had gotten himself into trouble by tweeting out $420 funding secured, and every word in that tweet was wrong or false. And the company's stock price had dropped to $185. So I sat down to value a company and I tried to be realistic. I said, look, I think this company is going to succeed. There's a reasonable chance of it succeeding. And if it succeeds, it's going to become a fairly large automobile company. How large? In my story, I see Tesla making about $105 billion in revenues by the time you get to 2029 or 2030. Just to give you perspective, the largest automobiles companies in the world, Volkswagen and Toyota, have revenues of roughly $300 billion. I'm making Tesla about as big as BMW. And while it's doing this, I'm going to assume its margins will improve as it becomes a larger company. Economies of scale kick in, and its margins are going to get to 10%, which is an optimistic number in the auto business. Typically, auto companies make single-digit operating margins. I assume its margins will improve. Along the way, it's going to be able to use existing capacity to grow for a little while, but it has to reinvest. Why? Because to increase its revenues from 29 to 105 billion, it's got to build assembly plants. So the reinvestment is estimated, assuming that for every dollar of reinvest capital, Tesla will make $2 in revenues. With those numbers built in, I get free cash flows. And in this story, you can see that I see Tesla having to go back to the market to raise fresh capital every year for the next 5. Is that bad? Is that good? No, it's just there. I take my story, I compute the present value, and the value that I get is $52 billion for the operating assets. And then I say, you know what? There is a chance, at least in June of 2019, that Tesla will not make it. Why? It's a young, money-losing company with a lot of debt. I attached a 20% chance it wouldn't make it. I was trying. I was bending over backwards to be realistic about the company. And with my story and those numbers, the value that I got for the company was $190. In fact, the stock, which is at 185.5, I said, look, if the stock goes to 180, I will buy the stock. I think the gods must have been listening, because a few minutes after I did this blog post and put up this value, the stock dropped to 180 and I bought the stock. I got incredibly lucky. 180 happened to be the absolute low for the stock, and over this next 6 months, the stock price kept going up and up and up. In January 2020, I revisited Tesla, and my story had become much bigger. Why? Because the company had gone through a period where they'd actually improved their margins. Their Shanghai plant was coming on. It looked like things were starting to work out. My story expanded. Am I okay with doing that? Absolutely. I'm telling a bigger story. Revenues of 128 billion of 104 billion. Higher margins, 12%. So I'm seeing it succeed. So the story I'm telling is of a large automobile company the size of BMW, with margins like a tech company, and reinvesting like no manufacturing company has historically, being able to get more sales for every dollar of capital. With that story, the value that I got for the company was $427. Remember, it was $190 when I did it last. I've doubled the value, but the stock price had gone up to $581. Remember, I bought Tesla at 180, and I'm sitting there saying, what do I do now? And I had to do what was consistent, which is when I bought the stock, I bought it because undervalued. I sold it, and I sold it actually at 640. Happy ending to the story, right? Not quite. There is a rest of the story I haven't told you. You know what the stock price did in the following 3 months? It went to 2,500. Did I leave a lot of money on the table? Absolutely. How do I explain it? I don't have to. I just have to be consistent with my story, and you can see my story drive my value. So you ready? I'm going to take you through this process, and you're going to try to value Tesla. You're saying, I've never done valuation. Don't worry. I'm going to make it really simple and boil down what you have to do into 4 levers. I'm going to ask you, what do you think about growth? What do you think about profitability? What do you think about investment efficiency? What do you think about risk? So in my valuation, if you remember, I've assumed revenues of 125 billion 10 years from now for revenues, 12% margins. I'm assuming that every dollar of capital you invest creates $3 in revenues, at least for the first 5 years. And I've attached a 10% chance of failure. I gave Tesla a 7% cost of capital. So you ready? I'm going to give you some background so you can make your best judgments. Let's start with this business. The automobile business is in trouble. Collectively, automobiles are starting to grow at very low rates. In the last 10 years, the compounded annual growth rate in revenues for global auto companies is about 3.5%. And if you look at the biggest auto companies, here's what they look like. The biggest automobile company at the time that I did this, in January 2020, was Toyota with $285 billion. So you can get some perspective on what large and small revenues look like. The biggest automobile companies have revenues of close to $300 billion. And if you look at the margins, the highest margins you see are about 8%. So the very biggest and the most profitable automobile companies, at least you're getting some perspective here. So here's my first twist. You're saying, well, what if I treat Tesla as a technology company? Just to give you some perspective, technology companies actually have much less in revenues than automobile companies. The largest technology company, Apple and Amazon, have less revenues than Volkswagen and Toyota. But here's what's different. Look at their margins. They're much higher margins. Not Amazon, but the remaining tech companies. What tech companies bring to the table is much higher margins. Already I can see your mind start to work. Keep it working, because here's my first question to you. What do you think Tesla will look like 10 years from now? Let me give you the choices. Look at something like Renault, which will give you revenues of 65 billion. BMW like 100 billion. Ford and Honda like 150 billion. Daimler like 200 billion. Or Toyota and Volkswagen like 300 billion. Or maybe you think that Tesla is going to blow all these automobile companies out of the air and give them growth of 50, 60%, which will give them revenues of 600 billion or 800 billion. But remember, no automobile company in history has ever had revenues that big. So make a choice. Now let's look at margins. Again, let me give you perspective on what margins look like for automobile companies. They look terrible. The median operating margin for an automobile company in 2019 was 3%. A high number was 7.5%. That's the third quartile. The first quartile is minus 6%. It is true, tech companies have much higher margins, the FANG stocks. But the reason for that is very simple. Microsoft has operating margins that exceed 20%. For a simple reason, the extra software unit you sell costs them almost nothing to produce. You can't do that as an automobile company. So the question that I would have for you then on Tesla is, what kind of margins would you give Tesla? And here are your choices. You can give them auto company like margins, 3%. The third quartile, a very good auto company margin, 7.5%. Maybe tech companies collectively, 10.25%. Software companies, it's a very strange story you'd have to tell. But already you can see the choice you make on margins depends on which of those stories you attach it to. So by now you've got a revenue growth component, a margin component. Let's look at how efficiently auto companies reinvest. Auto companies are not very efficient at reinvesting. Every dollar they invest creates about $1.37 in revenues. A high number for an automobile company would be 2.4. And software companies are not that good either. They also have issues. But when I estimate $3 in revenues for every dollar in capital for Tesla, I'm already making them much more efficient than any automobile company on the face of the earth. So your third choice is, how efficiently do you think Tesla will grow in the future? And again, the higher this number, the more efficiently it grows. So you got growth, you got margins, you got reinvestment. Now comes this issue of cost of capital. We make too much of this, we get into models, but the reality is, if you look across companies globally at the start of 2020, here's what cost of capital looked like globally. The median cost of capital in US dollar terms for a company is 7.6%. In euro terms, about 1% lower. The first decile, you can see that companies across the world now, if you look at their cost of capital, have very low cost of capital. And if you look particularly at automobile companies, here's what you see. The median cost of capital for an automobile company is about 6.9%. For technology companies, it's much higher. They're riskier. So when you think about cost of capital, I want you to think about where do you want to put Tesla in this table? Do you want to give them the automobile company median, or you want to give them the technology company median? And already you can start to see that if you start to pick the best in each number, you're creating this monstrous company with the best pieces of different businesses. And also, remember what I said, your company might not make it? What is that number for Tesla? And if you're a pessimist, you might go to the 50%. If you're a real optimist, you might go to 0%. I use 10%, but I'll let you choose that number. So I hope you made some choices along the way, because here's what your value for Tesla would be with your choices. Valued as an automobile company, no matter how optimistically you value it, the value that you get for the equity is about $68 billion, and the value per share is $333. Remember, the stock is trading at $600, even $640. So there is no story I can tell as an automobile company that gets me to $640. Maybe I can give it the best pieces of the automobile business, Volkswagen-like revenues and tech company margins. I get only $298. Or maybe I can get even more optimistic, give them big auto company revenues plus margins like the FANG stocks, Facebook, Alphabet, Amazon, the very best companies. And then I get to $800, $900, $1,000 per share. Or maybe I can assume that they will be Toyota-like in terms of revenues, have the software median as their margin, and be such a revolutionary manufacturing company that they get $5 of revenue for every dollar of capital. I can get to $2,000 per share. Do you see how the story you tell about Tesla plays out in value? So auto stories don't get me anywhere close to the value. Techie auto stories may be a little closer. Fangy auto company, then I get to 600, 800, 900. But if you connect the best part of everything, you give revenues like Volkswagen, Toyota, margins like pure software companies, a sales to capital ratio never before seen in a manufacturing company, the cost to capital of an automobile company, you can come up with the value of 2100. If that's your story, by all means buy Tesla. But ask yourself, which of these stories is possible? Maybe all of them are possible. Which are plausible? I think with the Fangy stories, I'd push back. How the heck are you going to get 18 or 19% margins when you're an automobile company? And when you create these stories where you take the best of different businesses, you can already see that your story is internally inconsistent. One of the things I closed off my Tesla valuation with is when you look at each of the numbers I use to value the company, and you ask me, could you be wrong? The answer is of course. So one of the tools I find useful in dealing with uncertainty is, rather than wring my hands and say, I feel uncertain, I took each of my big assumptions, margin, sales to capital, cost to capital, and revenue growth, and made them into distributions. I'm doing what's called a Monte Carlo simulation, where I draw a number from each of these distributions multiple times. In a typical Monte Carlo simulation, you run the simulation thousands of times. I ran it 100,000 times. And what do you get as output? You get a distribution of values for Tesla. The median value that I get for Tesla is about 400, still well below the 640. Remember, the stock was trading at 640 when I did this. Can I rule out the possibility the stock is worth 640? No, there is a possibility that the stock is worth 640, but the odds are not in my favor. Distributions of value give you more information to make your best judgments on value. So you can see how stories play out in value. That's a session that I did early this year, and then COVID hit on February 14th. And I was told that none of the stuff that I did pre-COVID would work anymore. In fact, I was told that you can't value companies. And if your notion of valuation is mechanical, you download financials and just forecast them, you're right. You cannot value companies by being mechanical. But if your notion of valuation is to tell a story, I would argue that more than ever before, it's during a crisis, you need to think more carefully about your story. So let me lay out how COVID can affect stories. This crisis has expanded some companies' stories. It's actually made them more valuable. By doing what? By allowing them to reach new customers, devise new business models that have staying power. Classic example is the platform we're on right now. I'll wager that many of you hadn't used Zoom until this crisis hit. Now we've all used Zoom. And after this crisis, my guess is a lot of the people who tried Zoom are going to stay on. Zoom is a company that has become more valuable because of this crisis. I know they're familiar with Peloton, but during this crisis, Peloton has pivoted away from their traditional model of selling expensive fitness equipment with this very expensive app, and they've sold the app to people without the fitness equipment. They've done really well. My guess is after this crisis, they're going to be worth more. So for some companies, this crisis has allowed them to reach new customers, devise new business models that have staying power. They're going to be worth more. Some companies, their stories have expanded by being in the right place at the right time. Take Moderna. Moderna before this crisis was just another small pharma company. It was working on this vaccine that nobody'd heard of, but it had been under the radar until COVID hit. Now it's in the center of the universe. It's one of those 5 companies whose vaccine is playing through the way. Guess what? Its value is dramatically expanded because its stories become much bigger. And finally, there are some companies whose stories expanded because their competition has been so badly damaged by this crisis. I think Tesla now is a more valuable company than it was before the crisis. You know why? Because its competition, Volkswagen, Ford, GM, has been so badly damaged that coming out of this crisis, Tesla has been strengthened. So this crisis is actually going to make some companies more valuable. It's also going to make some companies less valuable, making their market smaller, cruise line companies, airlines. And it'll make some companies smaller because they're in the wrong place at the wrong time. If you're an oil company, a commodity company, guess what? This crisis hurt you badly, nothing you could have done about it. And the risk of failure has become larger and less ignorable for every company. So here's what I need you to think about. You need to think about valuing companies in the midst of crisis. You got to separate the short term from the long term. This crisis is going to have real damage in the near term. 2020, 2021 are going. So get that out of the way. Second, revisit your story in the company. Ask yourself, how has this crisis affected that story? And third, bring in the risk of failure. For some of your companies, it's real and imminent. You got to bring it into your value. So a few months ago, in March of 2020, at the height of this crisis, I have this Excel spreadsheet for valuing companies on my website, and I took it and tweaked it. I called it my Corona version. People thought I was going to do something elaborate, but here's what I asked people to do. Separate the near term. Tell me how this crisis is going to play out in the near term versus the long term. How will it play out in the long term in terms of a story? Update your risk premiums. Crises affect risk premiums, affect the cost of equity, cost of debt, and the risk-free rate. And update the likelihood your company will not make it. And go out and value companies. So in July of 2020, I actually revalued Tesla. And you know what? I came up with a higher value than I did in February before the crisis for the reasons I described. I think coming out of this crisis, Tesla's potential market is much bigger. How much bigger? Look at the revenues I give Tesla in year 10, 203 billion, as opposed to the 100 and the 128 billion. I do think that their margins are going to be dampened because they have much bigger ambitions in terms of revenues. And if I play the story out, the value that I get for Tesla is $624. The stock by then was trading at $13.66. So I'm not saying I would go out and buy Tesla because it's got a bigger story. The market seems to have become even more upbeat about Tesla. The pricing has gotten out of control. So when you value companies, that's what you're looking for. Let me close this session by looking at 2 other companies, one helped by the crisis and one hurt by the crisis. I valued Zoom before this crisis as an online business meeting company. I liked the company, but the value that I gave it was about $30 per share. The crisis hit. I revisited the valuation in May of 2020. And I gave them a much bigger market. Why? Because coming out of this crisis, the online business meeting market is going to be much bigger, more lucrative. I gave them more revenues, higher margins. The value that I got was more than twice what it was at the start of this year. You're saying this is good, go buy the stock? The stock had quadrupled. So Zoom was helped, but the price got pushed up so much, I wouldn't buy the company. Which left me with one final valuation. If you think about a company, it's the eye of the storm is Boeing. And this is the valuation I did in March of 2020. And I told a pretty negative story about Boeing, where revenues would continue to shrink for the next 2 years, margins would be negative, and there's a 15% chance they will not make it. Not an upbeat story. But with that downbeat story, the value that I got was $161 per share. The stock was trading at 132. The story got smaller, but the pricing got even lower. It kind of re-emphasized the point. Just because you find something to be more valuable doesn't mean it becomes a good investment, because you got to check the price. Finally, just as a closure, a few weeks ago I revalued the FANG plus Microsoft and Apple, basically the 6 companies that accounted for 15% of the increase in value of all US stocks in the last decade. I found 5 of the 6 to be overvalued, but many within 10% of the value. I found Facebook to be undervalued. My most overvalued stock was Apple, but the point I'm trying to make is these 6 companies have seen their collective market cap increase by more than $1 trillion during this crisis. Why? Because their stories have become even stronger. The strong have become stronger. So I'm going to leave you with that notion of storytelling and how it connects to valuation, because that's what I want you to think about when you think about your company or about a company you want to invest in. What kind of story is there? How is this crisis playing out in the story? How will that story translate into drivers of value, and how does that play out as value? I hope you found this session useful, and I'm sorry I wasn't able to be with you today, but I hope this session helped. Thank you very much for listening.